All right. Today's Monday, the 12th of May. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Happy China Deal Day. Or shall we say Happy Capitulation Day? We shall see, because let's just dive right into it here first. Before the week even began, as we headed to the weekend, there was a lot of talks about we have a meeting with China in Geneva. And we've already capitulated to the Brits. So the assumption was we're going to capitulate to the Chinese too. And we got the news Sunday that there was an understanding, there is a framework of an agreement. And stock market futures loved that. But then we got the details today in the morning. And it was even, shall we say, worse or better than expectations, depending on what you were looking at. If you were looking at it for the market perspective, it was way better than expected. It was a huge capitulation, which again, if you're looking at it from that aspect of, are we really making a deal or capitulating? Or the capitulating was much, much worse than we've anticipated. Of course, the White House wants to tout it as a win, and you saw Besant coming out today saying that we have a total reset with China. We have a trade deal. We made a lot of progress. We won. We're going to examine whether these claims are right or wrong. But before we segue to that, over the weekend also, the Commerce Secretary Lunatic came out and said that the 10% baseline tariff will stick around for the foreseeable future. So that's going to be the minimum. 10% is going to be imposed in all countries, all of the imports that we get. That's going to be the floor. And depending on the country, of course, what kind of negotiation that happens, the tariff is going to vary. The UK got 10%. Other countries might get 20. In the case of China here, they got 30. And here are the details. The US and China agreed to reduce rates by 115%, which is, again, a way bigger percentage point than anybody anticipated, which, again, you could look at it from a positive perspective that, okay, at least the administration came to rationale and saved the market, at least for now. Or you can look at it from, then what was it all about? What was all the bark and huff and puff all about? Are we going to bring manufacturing jobs here? Are we going to have national security? Are we going to eliminate income taxes? What happened now? Because the tariff went down. So what is the point? We cut it down 115%. You got to remember China had already 125%. So when you cut by 115, the tariff on U.S. goods going to China, that's going to be 10%. But then we had a rate of 145%. So when we cut it by 115, we still got about 30% tariff rate on Chinese products coming to the United States. Now, Secretary Besant also added a really peculiar remark today by saying that the tariff agreement describe it as a strategic progress of decoupling with China. But what does that mean? You want to decouple with China? If you want to do that, you better keep the 145% tariff, because that's going to lead to decoupling from China. Not the capitulation, though. So I don't know what he's talking about. Now they call it strategic decoupling. Oh, we're not really decoupling. We're strategic decoupling. Again, they're trying to put a lipstick on a pig. But the reality is, as I will show you in a minute, and as we talked, by the way, when we covered the UK deal, the administration is boxed in the corner. The ports data was absolutely abysmal. And even if you happen to be a supporter, right now you might say, yeah, this is the art of the deal, and tariffs are okay because everything's going to be negotiated, yada, yada, yada. But once it hits you, as we get to the back-to-school season, that's going to impact the public opinion by voters. Many of them will be supporters or constituencies of the administration. So they knew that ahead of time, and they had to do something. The UK deal was the leading indicator, and now we have this China, which I would call a capitulation, a surrender, really. It ain't a deal. We haven't agreed on anything yet. Matter of fact, here's what happened. Trump caved, got zero in return, because nothing was offered. All we've done is we went back 10% on us, 30% on them, and that's that. And that's the same rate that Canada got. So all of this talk about, China, don't retaliate, because if you retaliate, we're going to hit you hard. But at the end of the day, that did not happen. Whether you retaliated or not, the tariffs went down to 10% either way. Of course, there's a 20% fentanyl tariff that's still on China, Canada. That's still going on. No manufacturing moved back to the USA. Again, a lot of the folks who are criticizing my criticism of the tariff policy said, Mav, you got to be patient because we're going to bring back manufacturing jobs in this country. We need it for national security, for jobs. What do you got against the blue collars, bruh? Okay, where's the manufacturing jobs now? Because you guys are jerking off all over the media, touting this as a win. What happened to the manufacturing jobs? I guess that's not important anymore. And the same thing, by the way, about saying that, Besant came out and said it. He said that the reason why we're doing tariffs is to eliminate the income tax. Okay, that was part of, hey, Maverick, you gotta be patient. You might not have to pay income taxes anymore, which would be good news for me. I'll just pay tariff, aka tax, on whatever I consume. But the government doesn't get to penalize me by 35, 40, 50% just because. Well, now what happened to that? Who's going to fund this? This is the most important question, by the way, from this whole thing. Who's going to fund the upcoming tax cut bill? Anyways, one step at a time here, folks. 30% tariff is still a huge tax on Americans. That's the reality. That used to be less than 10. Now you're paying 30%. So there is still an inflation aspect of all of this. 90-day pause still causes uncertainty. And Trump lost all of negotiation leverage. That's the reality, because now even Japan coming out and saying, yeah, if you want a trade deal with us, we're not going to do anything that excludes auto tariffs. You got to treat us the same way you treated the Brits. 10% on our cars, and that's it. Otherwise, we're not negotiating. And they know that the White House is going to capitulate. So we lost the negotiation power, the cards. I mean, the moment before the negotiations even happened, when he suggested that the tariffs could be cut to 80% before the negotiation, I mean, you knew it was bad. You knew it was surrender. And the reason is, here it is, as Charles Gasparino, Fox News, by the way, not me saying this. This is Fox News. He says, in talking to sources who run small businesses, the pause with China came just as their companies were on the precipice of disaster, since they sourced so much of their material from China, and the containers coming from China were coming back empty. If you want to know why we were as desperate for a deal as the Chinese, it is because small business, a key MAGA constituency, was about to get crushed. Amen. And this is a great take by, once again, Fox Business. Ain't me saying it, even Fox Business now. Gasparino is saying that we surrendered pretty much. We were desperate. We were boxed in a corner, as I've been telling you. And we had to do it at this point because we were heading on the cusp of a disaster with the data from the ports. But of course, we all know that the nature of politics in this country has become pretty much a cult mentality. You got your red cult, you got your blue cult, and they don't really stand for anything. They just defend their side and cheerlead for their side. So long as it's against the opposite side, which is again how this country is going to collapse later on. But a lot of talk in social media, let's say by the red cult, about, oh, how this is a win, and see, you guys were not patient, and we got a deal. What the hell are you talking about? What deal are you talking about? Are we exporting more to China to close the deficit? No. Have we gained any manufacturing jobs? No. Have we funded the budget deficit? No. All what we've done is we backed off. We reduced the China tariff rates to match every other country, plus the fentanyl tariff, which, by the way, could be negotiated to all what Xi Jinping has to say is, yeah, we're going to take care of fentanyl, and the 20% will be gone. Just give the market a little bit of stall, maybe down 2-3%, and they're capitulating that too. But again, folks, this is not the only news that demonstrated the cult mentality that we got in our politics today, of number one, looking at capitulation as some sort of a trade deal that should be celebrated. And the other news, of course, we have Trump here getting a luxury jet, Air Force One, from Qatar, $400 million, which again opens a lot of questions. The least of my concern, of course, is, oh, they're going to spy on us, because that's not going to happen. What bothers me is it's a bribe. Nobody's going to hand you $400 million worth of an airplane just out of the goodness of their heart. They're asking for something in return. And he's about to visit now. The president is going to be in Saudi Arabia overnight, meeting with the Qatari leaders and UAE leaders and everybody else. But of course, when criticized, Trump said that, oh, but it's a gift. I'm not stupid enough to reject a $400 million jet. And at the end of the day, it's going to retire in the Trump presidential library after I'm done being president, which is absolute bullshit, because, you know, the plane is not, this is a brand new jet, almost $500 million. They're going to park that in the library. Of course not. He's going to slap his logo on it and say, you know what, I'm just going to use it for my own personal use. A lot of iffy kind of questions about all of this. But again, the red cult comes out and says, yeah, we scored a win. We won. We got this beast for free. Who's we? Who's we? Am I going to get a ride on this jet? Am I going to get a share or some sort of a payment? Oh, he's taking the jet. It's a bribe. But it is the scary nature, of course, of U.S. politics these days for all of our foreign viewers. Just so you understand, because when I came to this country, I didn't know anything about Democrat, Republican. I thought the President, Reagan, that's it. So I came with an open mind. It's amazing to me, the evolution, to see, to witness the evolution of U.S. politics in a really ugly way, to be honest with you. But it is a slippery slope. It's the same thing when the Democrats were defending the corruption by the Biden family. Well, guess what's going to happen? It's a slippery slope. The next administration will take it a notch up in the corruption, and you're not going to like it. You're going to criticize it at that point. The same thing happening with folks who are supporting all of this. Your next president probably going to be Gavin Newsom. he's probably going to have the corruption on the open. Folks will just hand envelopes full of cash to the president because we're normalizing this kind of stupidity by being in cults and not thinking rationally and fairly and saying, hey, look, this is right, this is wrong, I'm going to support this, not going to support that. Doesn't matter who the president is. Doesn't matter what my political affiliation is. Goes hand in hand with the cryptos that we talked about. See, now they want to pass a crypto bill. A lot of crypto investors are waiting for the bill to be signed into law, but the concern is the president is using all of this to line up his pockets because you have his crypto coin where you can buy anonymously. And that's going to be your donation. Billions and billions and billions of dollars been flowing in anonymously. With that being said, did we get any positive news from the Trump administration today? Legitimately positive and a win, a real win for us? The answer is yes. And again, if they do something right, I'm going to praise the administration. If they do something wrong, not going to hesitate to criticize. You can pause and read the post for yourself, but in a nutshell, the Trump administration is now going to crack down against prescription drug pricing in the country. They're going to reduce it down by 30 to 80% is the proposal right now. And I say about time. We were getting robbed as U.S. taxpayers. We were paying more than any other country for the same drug. And that didn't make sense at all. And then you can't do generics because they manipulate the patent procedure in the government. We were getting robbed as taxpayers. And reducing the cost is a positive thing. Doesn't matter you're in the blue cult and the red cult, in between, doesn't matter. Positive news is positive news. And by the way, the big pharma stocks that were not really impacted that much because they were down already in anticipation of the pharma tariffs. So this news came better than expected. And also they're calling the bluff that he might say we're going to reduce it 30 to 80%, but then it becomes 15%. But it is amazing to me when we go back to the conversation about seeing the evolution of U.S. politics. This issue about the pricing of prescription drugs been going on for decades, folks. I remember back in the 90s, they would talk about this issue all the time, and nothing happened. We kept paying more and more and more, administration after administration, promising we're going to cut the prescription costs, but at the end of the day, what we get is more and more price increases because we know that our politicians are owned and controlled by big pharma companies. But it was the Democrats who at least pretended to be proponents of let's lower the prescription drug pricing. And then the Republican side always rebutted that by saying, but if we lower the pricing of drugs, then we're going to hinder innovation. There's a reason why we see U.S. pharmaceutical companies leading the world in innovation, in treatments, in discovery, because it is worth it for them to do so, because we're overpaying for it. The problem with all of that is we weren't just paying for the research and development and all of that. We were paying to subsidize other countries. So the reason why the drugs were cheaper in Europe or Australia or Canada, because we were funding the heavy lifting of the research and development of these drugs. Now it's going to be redistributed equally. At least this is what the president said today. Whether he's going to do it or not, up for grabs, because Big Pharma still has a strong hold over the Republican Party. But it's really interesting that when this news came out, the red cult was saying, yes, President Trump cares about America, America first. They're supporting a policy that traditionally Republicans did not support. And then you have the blue cult on the other hand, now saying, oh, but that's going to destroy the innovation and research that these companies can do, which is the Republican argument. Absolutely amazing to me to witness that kind of change in U.S. politics, but it is a product of the cult mentality that we have. Now, let's expand more on the tariffs and what to expect, because the problem is you never know. You never know what the president is going to do in the next step, because if the market goes higher and he feels better, he might shift to being aggressive again. For example, we got the news that Trump changes his mind and keeps the 120% tariff for cheap goods coming from China. So that's going to impact Temu and Shein and all of that. Maybe the Chinese will say, hey, wait a minute here, and escalate somehow. Or maybe Trump is going to change his mind with the criticism of capitulation, folded and all of that. Maybe he wants to look tough. Now that he feels comfortable, the market went higher. The other problem, of course, the damage from the tariffs, we already see it happening. For example, today, how does that jive with the win, right? Because Apple is now considering raising iPhone pricing without blaming tariffs. Because, of course, they don't want to be on the wrong side of the administration. But why are you increasing the prices on iPhones if the tariffs have been reduced? So that also brings up the question of price gouging. Now, of course, there are still 30% tariffs coming from any goods flying from China or being shipped from China. But it's also an illustration that you and I, the end consumer, we're the ones who are going to pay for the tariffs. And the companies right now will use this, whether they're impacted by the tariffs or not, they're going to use this as an excuse to begin to do price gouging. And that's an inflationary behavior in the economy. We have the CPI coming out tomorrow. I don't expect that we're going to see any of that in the CPI, but the PPI could be really important to show if there is indeed price gouging by the producers, which will lead to price gouging by the retailers, etc. Inflation becomes the concern once again. See, with the tariffs, the concern was recession. Now the concern is inflation. Once again, duality of the risk. And this is why you're not going to see the market being positive for too long, because the focus of the market will shift from trade, since we have pauses all over the place now, 90 days pause with China, 90 days pause with everybody. Trade is going to take the back burner. What's going to be front and center? It's going to be inflation, Fed policy, and the budget deficit coming from the upcoming tax cut. Matter of fact, now Goldman sees that the next Fed rate will be in December instead of July. So the odds were that by July, the Fed will cut rates. Now it's December. Soon enough, it's going to be no cuts this year. And Jay Powell was open to that when we did the FOMC review. He was open to that possibility. And the market did not like it. So the market is going to begin to shift. Today was relief that, okay, at least we're not going to go crazy with the tariffs and destroy the economy right off the gate. But what about the rate cuts? Because the market was betting on that, now it's not going to happen. Furthermore, look at this headline right here. Because when we were criticizing the tariff policy, a lot of the folks said, Mav, you don't understand. The tariff money is going to increase. We're going to make a shitload of money as a country, and then we're not going to have to pay income taxes. Well, guess what? The receipts last month topped $16 billion from tariffs, which is an increase, and it helped actually reduce the budget deficit. The T Department recorded $16 billion in customs duties revenue for April, making a $9 billion or 130% increase on the same month a year before. That is the biggest monthly take for customs in at least a decade. So yes, we were collecting money. We would have collected more had we kept the Liberation Day tariffs. Maybe we would have made, instead of 16 billion, we could have made 30 billion, 25 billion. The problem is, even if you do that, let's say we do 25 billion a month. No reductions, nothing bad is going to happen, just 25 steady Eddie, $25 billion a month from tariffs. Well, in a year, that's going to be about $300 billion, which is still a drop in the bucket when it comes to the budget deficit. So here comes the other question. Now that we've eliminated whatever contribution came from tariffs to reduce the budget deficit, how the hell are we going to pay for the upcoming tax cut bill? Because the proposal last week was we're going to tax the rich. That didn't bode pretty good with the Republican Party and the business class. So now they're backing off and they're going to do it the old school way, which is increasing the deficit, baby. The new Republican tax bill to raise debt limit by $4 trillion. So we're going to add $4 trillion budget deficit national debt to fund the tax cuts. And the main concern of the market is going to shift toward this issue now that the trade policies are behind us, at least for now, 90 days. Then we might revisit the topic later on, but right now, who's going to fund the budget deficit? Because you've seen what happened today with interest rates. Bond yields went significantly higher, meaning that the cost of borrowing is increasing. So the cost for this $4 billion will increase. And the main problem that we faced in equities and in the market all in all was the fact that rates were going higher. Rates go higher, of course, when bonds are being dumped. And now we're back to the same problem. So I see the euphoria that we got today as maybe sort of a relief in the market, that the worst in the trade policy is behind us for now, for 90 days. But soon enough, the market will have to wake to the reality of, what about the budget deficit? What about interest rates continuing to go higher, which will lead the Federal Reserve not to cut rates at all this year? I think that's going to be the focus in the next few days as we get the CPI, PPI. So folks have to be really, really careful. Let's revisit the strategy, because I think we've done pretty good in the strategy that we put out last week. So on the 9th of my Discord, I did a morning brief. And I said on Friday that good morning, it's almost certain that by Monday, Trump will lower the tariff against China to 50 to 80% range. We got even better. We went down to 30. So what I will do by the end of the day is to grab stocks and trades related to U.S. ports, such as shipping and trucking stocks. I will give you my concluding note here before the close. For the session we have ahead, this is Friday once again, you got to watch two indicators, gold futures and credits, meaning HYG and J&K. You need to see gold futures down, HYG, J&K up with the market to confirm the validity of any pump we see pre-market, because the trend has been that the market gains overnight and sells during the session. And we haven't seen that Friday. We've seen it today when gold futures went down, but the HYG J&K went up, which again supports the risk-on sentiment that we see right now. But if the market concern begins to shift toward debt in the bond market, then you'll see HYG J&K reversing down again. You're going to see flows back into gold, and that's going to be a warning sign that you got to be careful now. Probably the rebound is already priced in. The trade deal, wink, wink, with China. And now we have sell the news. I gave you the concluding note before the close, and I said we have upside risk going into the weekend because of the talks with China. Yet at the same time having skepticism by market participants about the final outcome. So we deployed a 3-layered strategy because there was a lot of danger going short into the weekend. There was also a lot of doubt going long into the weekend because we've heard a lot of good talk before and nothing really materialized. So a 3-layered strategy is the best way to do it, and I think we've done a good job in it. Neutral strategy opening the E-mini S&P futures, the September contract. We're doing an iron condor. That's a neutral strategy that by the expiration date, which we have it here at June 20, the S&P is going to trade within range. So we sold the 6,100 calls and the 5,900 puts. And we bought the 63 calls and the 4,700 puts. All in all, receiving a credit of about 8.40. I'm not worried about the E-mini futures rallying all the way to 6,100 anytime soon. But even if it does, there are a lot of ways to maneuver around it, to roll or open other kind of spreads to keep a portion of that credit as a profit. Then we've deployed a bullish strategy. We're going to keep NVIDIA calls. The spread's expiring next week, and today we closed those by the end. We closed the NVIDIA 115, 125 calls, expiration date May 16th, which, by the way, we placed back in April. The trade was dead for a little while, but now it came back, and we scored a pretty decent return out of it. Almost 100% worth of gains, and we closed also some calls we got in Carnival Cruises with gains of almost 100%. Going back to the note, I said that I'm adding some port bets, and we discussed this in details in the chat session that any shipping or trucking stocks like XPO, like Matson, all of them will do okay, but I picked GNK Jinko, and I picked KNX Knight Swift. One, of course, was shipping Jinko, and the other one is trucking from the ports Knight Swift, and we grabbed shares on those. And today we did pretty good. You got Knight Swift closing with gains of about 10%. There were actually gains of about 14% in the morning, but 10% is good enough. And Jinko was up about 5% for the session, so these kind of hedges played out pretty good. Then the bearish strategy is SQQQ diagonal call spread, buying the 30 calls with the expiration date of May 23rd, and then selling the 32 calls with the expiration date of May 16th for a cost of 90 cents. And again, we've raised about 840 from the E-mini futures, so that's just a fraction that we're using for the bearish strategy. Obviously, this leg is not working out, but we still got all the way to 23rd with the 30 calls in the SQs. That way, if we have any 180, if something bad happens, the trade is still here. Today, I gave you a morning brief just to add more to the conversation. Now, usually I would not share such a long morning brief with you and waste your time, but this is important to put in perspective. This is why I'm going to read it for you here. I said, now that the capitulation and tariffs is done with a 90-day pause in all countries, we have to examine the glass half full and the glass half empty to make decisions. The glass half full, removing the tariffs for 90 days will relieve consumers from the worst outcome of price increases and empty shelves before the back-to-school season. This will begin to improve consumer sentiment to spend in the economy again. Because remember the video that I produced yesterday? If you didn't check that out, you gotta. We talked about the affluent consumer and how the affluent consumer is becoming a little bit uncertain about the economy, so they're reducing spending. That's going to what we got today is going to restore a little bit of confidence. So it is important for you to go back and watch that video. Anyhow, I said this should be good for bank stocks as consumers and businesses take advantage of a 90 days pause to secure loans before rates head higher, as we've seen the 10-year today. So let's say that you're worried about maybe restoration of the trade war and you're a small business. You want to take a loan to secure some inventories, extra inventories, right now before the rate goes higher again, because you never know. Well, now you're going to take that loan. That's going to be pretty good for the lender. I said this also including auto loans to buy vehicles before the 25% tariffs begin to impact inventories, because you got to remember the 25% tariff in autos, that's still here. Only the Brits got the 10%, which we're going to talk about in a minute. But likewise, affluent consumer, goes back to the conversation from last night's video, will feel less worried and resume travel plans, which should give a temporary boost to airliners, cruises, and hotel stocks. They did pretty good today. It should also bode well for company stocks that were involved the most to the tariffs, such as Apple and Chinese stocks like Baba, Baidu, Pinduoduo. It is also good for energy stocks where worries about reduction in Chinese consumption is eliminated. Likewise, the pause should be good for transport stocks tied to ports. So what is the strategy? I'll be adding to my stakes in Knight Swift and Jinko. I will also add to my recent stake in Baidu. So I think we bought Baidu a couple of weeks ago. We're going to add to that position. We'll add 3 new positions. KMI, this is Kinder Morgan because the energy aspect of the optimism that we got today. AN, AutoNation, because not only, as we'll see in a minute when we talk about the CPI preview, not only we've seen acceleration in buyers go into the dealership, the showrooms, and beginning to buy before the tariffs hit in. But now that you gave the consumer a little bit of certainty by reducing the China tariffs so they don't have to worry about, oh, what am I going to do in the back to school season? Well, now you can make a decision and say, you know what? I can be a little bit more liberal with my budget, and the 25% tariffs on autos, that hasn't been reduced, so maybe I should use the money and go ahead and buy a car. More on that in a minute, but I also added the ticker MOV for Movado. So we talked about YKMI, we talked about AutoNation, and I told you exactly where I'm going to set the stop loss of the 200 DMA, but what about Movado? Because if you think about the discussion that we had last night when we talked about the affluent consumer, my hunch is we have portions of the affluent consumer who are reducing spending. So I said instead of buying a Louis Vuitton bag, for example, they're buying a Coach bag. And the same thing comes to watches. You want to buy a gift, you're probably not going to go with something like a Rolex, for example, but maybe you're going to opt for a Movado. So that kind of downgrading by the consumer within a certain category could be beneficial for certain stocks. And this is why we went with Movado. Not to mention, of course, it pays about 9% dividend. So it was worth taking a shot on. Again, you got to do your own homework before you follow any of these moves that I'm making. But we also looked at the glass half empty. This is really important for you to understand. With the pause in tariffs, renewed worries about inflation are being reflected in the bond market. Likewise, worries about funding the upcoming tax cut bill will also begin to dominate, and trade takes the backseat. Taxing the rich to fund it means they will sell their stocks before the tax increases are set. And especially now that a lot of stock prices went back, recovered a lot of the losses, so they can sell at a better point. Anyhow, also the focus will shift from the trade to Fed policy. And you saw what Goldman said, no more cuts in July. Next one we see is December, which will be more restrictive, as I said in the morning brief, as the July rate cut is now off the table. The dynamics makes me more cautious not to be sucked in the narrative or sentiment of the day, and rather use logic and tactic to choose long exposure based on the tariff pause. It will also prompt me to use the pop to exit some of my risk-on positions that I was stuck in, mainly in software, to free capital to trade against the market once this 90 days pause optimism is all washed out, and the market's focus shift toward bond market deficit and Fed policy. So I had a bunch of software names that I bought recently, like Team and Magnite, that I'm underwater in. Now that they came back up, I'm going to use the opportunity to exit, raise that cash, and wait for the market to flip back down. And again, it is really important in a market like this to have a strategy. And when you read my strategy, you might disagree with some of it, some aspect of the strategy, but at least it will give you a framework where you can take the parts that you like and then add the parts that you like and formulate your own strategy. But you got to have a strategy. You can't just react based on what happened overnight or what happened in the previous session. You're just going to fall into traps all over the place, not following a certain strategy. So this is the beauty of what we do every day in Discord. We're going to update you again. If anything happens, we'll update you again in Discord, step by step on what I'm doing. Anyhow, let's talk about the CPI preview, because I said that last night. CPI is not going to be that important. I think the PPI is going to be more important because we want to see the producers are beginning to front load the increases in pricing. And if we see that in the PPI, that's going to be problematic. But the CPI, I'm not expecting any huge pop, except maybe in one category, and that is new cars. So all eyes are going to be on new cars tomorrow, for me at least. Even though I think that the CPI is going to be pretty much pale in comparison. Let's put it that way. I don't want to say nothing burger because it could be, but it's going to pale in comparison with the importance of the PPI. But here's the headline for you. It says U.S. car prices higher in the month of April after tariffs hit. What are they talking about? Here it is. U.S. new vehicle prices surged in April. Data released on Monday showed a sign that the effects of President Donald Trump's auto tariff measures are rippling through the car market. The average price consumer paid after discounts and promotions rose 2.5% for March, more than double the typical 1.1 increase over those 2 months in recent years. Cox Automotive's Kelley Blue Book showed in the past decade the only larger such increase was in April 2020, when prices rose 2.7% during pandemic-related factory shutdowns. Why do we see the pricing going higher? It ain't just the tariffs, by the way. It's because of the increase in demand, because the consumer is also trying to front load before the tariffs and buy a vehicle now before it becomes 25% or more expensive, and that's pushing pricing higher. Take a look.
As tariffs threaten to raise the price of new cars, Americans are racing to the showrooms.
Chris Van Cleve reports they are trying to beat the price hikes.
Akio Miller and his wife are accelerating their search for an SUV.
It is very smooth drive, too.
Test driving a new Hyundai that could soon see a price increase due to a 25% tariff.
With everything going on with the up and down with the tariffs and the car prices, I was like, you know what, we need to probably look like sooner than later.
You feel like if you don't buy it now, you're going to pay more later?
I definitely feel that way. Cars are already expensive, and then now they tacking on the extra tariff taxes, I like to call it. It's going to be way out of price range.
The Millers are far from alone. March saw new car sales surge nationwide, jumping over 17% from February and nearly 12% over the same time last year, while driving down dealer inventory of pre-tariff vehicles by 10%. Economist Patrick Anderson.
You got a lot of sales in March that were basically people buying ahead of the tariffs. And that means, unfortunately, we're going to have lower sales later on when those people aren't buying cars that they originally intended to buy.
90% of this car was made in Korea. Seems like a vehicle that would get hit with a significant tariff. Its sticker price right now is almost $51,000. Would that go up?
No doubt it would go up. The question as to how much it would go up.
That unknown led to a record March for George Glassman's Subaru, Hyundai, Kia, and Mitsubishi dealerships in suburban Detroit.
We've stocked up in anticipation of higher prices.
How long do you think then, after tariffs would go into effect, that you would start seeing that ripple into your costs and ultimately what people pay?
It'd be immediate. I don't think there's any doubt about it.
Now, it is a shame because 25% of all vehicles coming to the U.S. from any other country you want to pick, including U.S. cars coming from Mexico and Canada, by the way. So when you look at the import as a share of U.S. vehicle sales, VW is the most exposed, Hyundai, Kia. 65% of the cars are imported. So 65% of cars, Hyundai, Kia, will be subject to 25% tariff. But since we've done the capitulation with the Brits, you buy a Rolls Royce, you're going to get 10% tariff. So how's that a win for the middle class or the working class, by the way? When you're giving discounts for Rolls-Royce buyers, but you're punishing Hyundai and Kia buyers, which happen to be, again, middle class, working class, you're going to punish them. Not to mention, of course, auto loans are going to be more expensive. So again, none of this really makes sense to me. But you see the Benz all the way down to Ford. They have a big percentage of imports as a share of U.S. vehicle sales. So we'll see what happens with new cars as a component of the CPI tomorrow. But you see that the average vehicle price is still way too high. $47,462 in the month of March, 22% higher than 5 years earlier. So the quality is going down, but the prices are going up. It's an absolute tragedy for the working class in this country because you have to dig deep in your pockets and take auto loans and be drowned underwater just to own a car. It's an absolute shame. And if prices go higher again because of tariffs or front loading, that's going to be disastrous because it might be the component that flips the CPI into something, let's say, more ominous. When I say ominous, I'm talking about the Fed rate cuts. Maybe we're not going to have December anymore. That's going to be problematic. But of course, tariffs are pushing vehicle prices costs higher. So you look at the U.S. car maintenance and repair costs, 58% higher than a decade ago. And the cost keeps going higher and higher. So again, you want to look at new vehicles in the CPI and also the cost of owning a vehicle. So that's the CPI preview for you. Not a lot, just one category that I think will be interesting tomorrow. But all in all, I think that the CPI will not be as important as the PPI. Keep that in mind. Now let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices. And here we go. The diamonds in the green, 1,160.72 points, or a gain of 2.81%. The NASDAQ leading the way to the upside, 779.43 points or a gain of 4.35%. The SPDR also positive by 184.28 points or a gain of about 3.25%. The leading indicator was positive too, so no problems here. The Russell 2000 was up 7.06 points or a gain of 3.52%. When we look at the sectors today, of course, risk on rotation, so we see cyclicals, technology, industrials, communication services leading the way, while we see utilities and defensives leading the way to the downside, but it's not a mass exodus. We don't see a lot of losses here. It is just a little bit of more capital flowing into the risk-on segments. Was the breadth too excessive today? The answer is not really, so that opens the path for more gains to come if the market wants to do that. The NYC was 81% advancing, 18% declining. The NASDAQ was 75% advancing, 23% declining. Looking at the heat map, really interesting because you see anything that is risk-on, anything we talked about in the morning brief, the banks, technology, comm services, all of them are up big. Anything that got hit because of recession fears stemming from the tariff policies rebounding big. So there is an element of relief in this map. The most interesting part of today's map is healthcare. Because we got the bad news, quote unquote, bad news for the big pharma, of course, that we're going to cut the cost by 30 to 80%. And you would have thought that this is going to be a negative for the big pharma companies, but look at these gains. Merck is up about 6%. Gilead is up about 7%. AbbVie up about 3%. Amgen about 3.5%. Pfizer, Bristol Myers, all of them are blasting higher. So what's up with that? I think once again, better than expectations. I'm also calling the bluff that he's probably going to back off. It's going to be about 15%. Which is no biggie for a big pharma. Now, what do we see in the red? This is really interesting. You see the classic defensives, and this is really important for you to write some notes on it because at some point the market will flip back to defensive mode again. And the map right now is telling you which stocks to buy once we flip back to defensive mode. So watch the negative reactions that we got today. Forget about healthcare or CVS. That's because of the bill that we just talked about. But if you look at the industrials, you see waste management, the garbage stuff that is considered defensive within industrials. That's down for the day. In real estate, we talk about American Tower as the defensive. That's down today. Utilities, we talked about the classic utilities, Duke, Southern Energy, Next Era, Dominion as the defensive formation. Well, now they're selling off because today's a risk-on rotation. You look at the defensives, aka staples like tobacco, grocery stores like Kroger, Coke, all of them are down today. The gold miners, that's another defensive, also down. You look at financials, the insurance companies like Progressive, that's down, that's defensive. You look at the telecoms, T-Mobile, Verizon, the classic telecoms are down. Those are defensive. What's really interesting to me, and I tweeted about this today, the new utilities, Netflix and Spotify, were down today. Netflix down about a little over 2.5%, Spotify down about 4.25%. Why do we see this? Because these two names have been treated as classic utilities. You're not going to cut your electricity bill. You're not going to cut that. You're still going to pay electricity. You're still going to pay your water bill if we have a recession. And guess what? It's going to take a lot of economic pain for you to cancel Netflix or Spotify. And hence, they are the new utilities. And if we have a risk-on rotation, these names sell off. So today we got proof that these two names are indeed defensives, at least for now. Moving on to commodities, with the dollar moving significantly higher after the trade capitulation. We see a negative impact in metals, so we see gold, silver, platinum, copper, palladium all down. Now the pullbacks in metals, in my view, will be an opportunity to buy at some point, not right away though, because the dollar is going to come back down with the budget deficit problems and no rate cuts and all of that, and the dip in you see right now, palladium and copper and gold will all be buyable at some point. But hold your horses, don't do any knee-jerk reactions. We see soybeans and grains doing pretty good, but modest pullbacks for corn and wheat. In softs, we see coffee pulling back about 3.5%, modest gains for OJ and lumber. But the most interesting aspect is, of course, energy, because crude oil was higher in both the WTI and Brent, gains of about 2% apiece. That comes at the expense of nat gas, which when we see a pop in Brent, we see money coming out of nat gas. So it's down about 4%. It is really important to watch crude oil futures because if they continue to go higher, that's going to be indicative of the inflation problem in the economy. And now we're shifting the focus toward inflation. If it flips back in the red again, though, that's going to be an early warning that watch out, we're probably going to flip back to the recession fears again. So watching crude is really important. We'll look at the charts in a minute. Moving on to the big casino options, what do we have here? The volume, believe it or not, is still shy. It's not, let's say, down half. I would say it's missing about 20%, 30% of what we used to have. And is that a product of hesitancy by the traders? Because the majority of the gains happen overnight. You open the tape and you can't do anything about it, even if you want to chase. Even if you say, you know what, we got good news about trade today. It doesn't make sense to chase. You're just going to overpay, and then the tape is going to consolidate and do nothing at all. You're just hoping that it's going to gap higher again overnight. Majority of the gains happen in the overnight session. Majority of the losses happen during the session. So the only interesting trades that we can do intraday are trades to the downside, but not the trades up, unless you do them at the end and you're confident that we're going to see a gap up in the pre-market session. So this kind of environment is a little bit difficult for options traders to guess. I think that's part of the hesitancy that we see here. But yet we see calls dominating puts, not by a lot though. When we see the IV ranks, this is the good news. The IV ranks are now in the 20s and the teens. So the pricing of the puts is cheaper. And of course, when folks want to buy puts, they buy them when the IV ranks are already exploding higher and they end up overpaying for them, not making a lot. But this is the time when you want to buy them. But nobody wants to buy them right now because everybody thinks that the market is going to go higher. I'm not going to suggest that you open bearish positions right now using or exploiting the IV rank. I would say exploit the IV rank and the reduction in volatility right now, this moment, to hedge your long stocks portfolio. Look at the damage that happened in the first quarter of this year. We want to avoid that on the longs. So when we see the IV ranks going down, volatility, the VIX going down, we want to use that opportunity to hedge. And you got to go deep. You got to go to September, you got to go July, and just have that comfort of mind that if my stock goes down a certain level or flushes down for whatever reason, I have the right to sell at the price that I would like to sell at. And the puts right now are cheaper. If we begin to see, for example, the market topping, IV ranks beginning to bounce higher again, then we can discuss opening short positions, because even if you open them at an IV rank at 30 or 40 or even 50, there's plenty of room for appreciation. Now let's do the unusual activities, beginning with the bullish ones. It's for UNP, Union Pacific. Another shipper. Of course, if we have tariffs and the ports are empty, then that's going to impact the railroads negatively. But today the railroads were up big as part of the restoration of hope that the ports will be busy again. But here somebody says that we have more gains to come. We haven't really recovered the damage yet. And I agree with that a little bit. This is why I'm holding into my trucking and shipping stocks. In this case, they bought the 250 calls for the expiration date September 19th, 2025, spending about $2 million. Now, UNP is trading at about 230, so they're betting on a decent appreciation of value here. Then we have AbbVie, not scared about the tariffs, not scared about the reduction of the pricing that we pay for AbbVie drugs. Somebody here bought the 210 calls. Stock is trading at about 190 right now, so again, a huge appreciation of value. The 210 calls, the expiration date August 15th, spending about $1.5 million. And then we have the bearish ones. This is really interesting for the Qs, a diagonal spread. What they're doing right here is buying the 450 puts. Mind you, the Qs is trading right now above 500, so that's a steep decline. But notice that they're betting on that happening in the back end of the year. They bought the 450 puts for the expiration date of November 21st, 2025. Then they sold the diagonal. To reduce the entry cost, they sold the 425, but for an earlier expiration date. That is August 15, 2025. What is the bet here? They think that the Qs will be below 450 by November, maybe even below 425 by then. But they ain't going to be below 450 or 425 by August. That's the idea. All in all, spending about $64 million. Big one. And then we have the SMH, semiconductors, again, skepticism showing up. As in Fade the Rep with Southern News, they bought the 225 puts, the expiration date May 30, 2025, spending about $2.5 million. Here's another one for you, VST Vestra, data centers. So they're fading also the data centers and the chip play. They bought the 135, in this case, 135 puts, the expiration date July 18, 2025, spending about a little over $1.5 million. Another bearish one for you for software. So we're getting pops in software. I'm using the opportunity to exit for most names. Of course, we're going to add Trade Disk because Trade Disk is cheap, but I'm going to exit the others that I got. And I think that somebody agrees here that the pop in IGV software is not going to last. They bought the 100 puts for the expiration date June 20, 2025, spending about $1 million. Let's do some of the charts here, the most important ones, and then wrap it up. We begin with the E-mini futures daily chart. We went all the way back to the 200 days moving average, and now the moment of truth. Can we trade above or will we see a rejection and we go down? Now look, you don't want to be too fixated on the moving average, at least in the daily chart, because as we've seen in 22, we can go above the 200 and then lose it again and resume a bear market. But it's going to be interesting to see the reaction at the 200, with some traders, investors begin to sell. And that's going to be a vote of no confidence in the rebound that we got today. Most importantly, look at the weekly chart. The 50 in blue becomes the most important moving average, and right now we're trading at or below that number. So the weekly close will be more important. I think the weekly close at the 50 weeks more important than any daily close of the 200 days moving average. Keep that in mind. Now, the NQ, the NASDAQ, it's above the 200 days moving average. But again, the NASDAQ doesn't really matter. It's all about the SPY. Where the technicals matter, the Qs are just going to follow what the SPY does. So again, you don't want to be too fixated on the technicals in the NASDAQ, because you want to look at the SPX, SPY, E-mini futures. That's going to guide you better. In the Russell 2000, we're short. We're not at the 200 days moving average or above. We're still way below. And I see the number 2,125 as a strong resistance. So I'd love to see a close above before we bet on a revisit of the 200 days moving average in the RTY Russell 2000 futures. There's still a possibility of a failure from this point on and a reversal. Looking at the leading indicators like the dollar, for example, the dollar is popping higher. That's good news for the market, as we said when we studied our indicators list. Now we have resistance at the 50. Does it mean that's going to flip or get rejected or just go down again? But it's going to face some resistance, maybe consolidation for a little bit. And if it passes the 50 days moving average, then you have the orange line. That's going to be the 200 days moving average as the next step. And again, higher dollar is pretty good for the market, at least right now. When we get to a point where higher dollar is reflecting stricter Fed policy, then we're going to have problems. So now we look at gold, negative divergence that we talked about in, I believe, a couple of morning briefs ago as a leading indicator that is supporting the market to continue to rebound. Where can we find support in gold futures? I think the 50 in blue has to be retested, and that's going to be an important point to see what the reaction is going to look like. Can we see buying of gold again, dumping of the dollar? I think you need a catalyst to that, because right now we are seeing outflows out of the defensive gold to chase the risk-on rotation in equities. If that flips, if the VIX goes higher, dollar goes down because of the bad CPI or PPI, or somebody said something about China, and you see gold going higher, then okay, that's the dip that you want to buy, because it means that risk-on rotation is over, stocks will go down, dollar will go down, we go back to defensive, and the king of defensives was, at least in the first quarter, gold. Looking at crude oil, what do we see here? Double bottom right now, but short of the 50 days moving average, short of my number 64. The trend is positive, so we're going to give it the benefit of the doubt that you could make it, maybe consolidate a little bit like the dollar underneath the 50, because crude oil right now is trading with the dollar. And we see that from time to time, by the way. I don't want to go into the reasons because that's a separate video. We talked about the subject before, but I don't want to waste a lot of time here. So right now, crude oil is going to trade along with the dollar. HYG, really important indicator. Now it's above the 200 days moving average. I think this is the most bullish indicator for the market right now. So if it flips, if we lose the 200, then we got a problem. Otherwise, it is supporting more upside in equities. Now, the problem is the 10-year yield. I'm looking at the weekly chart for a reason. We're now above 4.3. Not good. We have an inverse and a shoulder pattern. Not good. Look at the momentum in the MACD, the Vortex, the RSI, all showing an upcoming shift from bearish to bullish, meaning that yields are going to head higher. So I heard a lot of you today in Discord saying, I want to buy the TLT. Why would you do that, though, when yields are about to head higher, especially if we have a hotter CPI, PPI? Got to be careful with that. If yields continue to go higher, then we have the same problem once again, which is dumping of U.S. bonds, volatility in the bond market, and higher interest rates, which will choke the economy. So keep an eye. This is the only bad indicator that we got for the market. Another indicator is Bitcoin. Bitcoin is doing pretty good right now. It broke out in a bull flag pattern, now maybe forming another one. Got a little bit of resistance at 104,000. And again, we're not going to be bearish in Bitcoin again until it loses the 200 days moving average. So absent of doing that, it's still pointing out for risk-on sentiment all in all. And that's positive for the stock market. So we need to see these indicators flipping back before you become bearish again. I understand that maybe there's excess and a lot of folks are doubting and being cautious. I agree with all of that. I'm only picking tactical longs right now. I'm not chasing the market. At the same time, I'm not being adventurous and just stubborn and buying puts randomly every day against the index, hoping that it's going to be the day. I got to see a few more steps before I do that. So stick to the strategy, folks. A lot of thoughts are being put behind it for a reason. At the same time, do your own homework. Maybe there's part of my strategy that you're not going to like. You want to replace it with your own. Good for you. But please have a strategy before you randomly begin to place trades left and right. Now let's segue to the conclusion of this video. What do we have in the economic calendar tomorrow? We got the optimism index for small businesses. It is important because I think the reading is going to be bad because this was the month of April and we got the Liberation Day. So you might, in China tariffs were not backpedaled. So small businesses might be a little bit more pessimistic than, let's say, the real-time reading. So that's not going to be really important. What's going to be important is the CPI because it is the only data that we got. CPI, of course. I'm looking at the core CPI. If that comes out hotter, it's going to be because of new cars. So we want to keep an eye on core CPI tomorrow. But like I said, CPI this week is going to be, or this month is going to be less important than the PPI. Looking at the earnings calendar, not a lot tomorrow. We have some names like C Limited, if you're trading that, JD.com. But we're going to take a break from earnings right now and focus on the CPI a little bit more in tomorrow's session. Take a break from the trade problems, by the way, and focus a little bit more on the budget deficit, the Fed policy, and that might begin to bring back bearishness in the market. You got to see some indicators, though, beginning to flip before you do any move. But for now, folks, this is all I got for you. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.